What's up, guys? In today's video, what I want to talk about is making money with the iterations. Making money with the iterations. Now, when it comes to advertising, the landscape, you have agencies pitching a dozen different things, dozen different strategies. You have D2C founders that don't know what they're doing or what's giving them the highest ROI possible. So let me define and repaint the picture of the North Star. The North Star is capital efficiency. You should be aiming to make money on the front end, and depending on your cost of goods, you can do that by recreating and recrafting the offer. On top of that, you have to look at, okay, the lifetime value. Are you making money from the lifetime value? Because if you're not making money from the lifetime value and you don't have repeat buyers in a 12-month cycle, you don't have a business. So if that's the biggest issue, well, then the strategy is going to be very different to where, let's say you have an apparel company. Like if we look at Lululemon, who only sells clothing and different fabrics, well, they have a ton of different product verticals that they have and they promote to their customer base. So like, for example, you might want to fatigue out one single hero product, and then on the back end, upsells should be these other verticals that go hand in hand. For example, like a yoga shirt that goes for the gym. Well, then you can do pants, you can do socks, you can do yoga mats. Lululemon does yoga mats, right? So that's kind of the big gaping issue. The number one thing to focus on is, where are you capital efficient? Do you have a front end acquisition problem where you're not profitable there? Is your lifetime value good? Because then this advice is going to be more tailored to your specific decision making, or these principles I'm going to share with you guys. So now let's take a step back and analyze what capital efficiency dialing in the unit economics looks like. So when it comes to front end acquisition, the offer is the most important factor out of all things. Everybody in the D2C landscape runs 10% off, 15% off, buy one, get one free, right? The thing is, and Hermosi covered this, how does one extract perceived value? How do you define value? Well, it's into two different categories, right? You have what someone is willing to pay, what is their end desire, how long does it take them to get that desired result, and on top of that, is there friction? How much friction do they have to go through to get to their desired end result? And that equals your perceived value. Now, a value add would be, let's say you have a supply of knives. Let's say you sell one knife for $65, and then when that purchase, with every purchase of that one single knife, the brand new prospect can get a free value of $86 worth of knives. Compared to that, that's a better offer than, let's say you have a bundle package of knives, you sell that for the same price point, but you get free shipping, lifetime value, you have a guaranteed return, right? They can refund or whatever. The value is so much higher because if we look at human psychology, people love stuff for free. And when you perceive the actual product as they're getting more for what they paid for in advance by this kind of free method, buying behavior is so much higher compared to just doing 15% off, 20% off, free shipping. Like all that stuff is standard. Every single company is doing that, right? So when it comes to dialing in unit economics, you want to create a higher AOV bundle package to where you can have people are buying more than one product, which is the value is going to go through the roof. You can have a price point where this product's typically priced at $230, but when you buy with this product or with this bundle offering for a limited time, we give you this for free. And on top of that, the perceived value goes from $135, $140, $150 product to now a $230, $300 product, because you're stacking products together and you're stacking out offers. And your cost of the margin to get a profitability CPA or a profitable CPA is substantially higher because the threshold has been minimized by charging higher ticket. So when you charge higher ticket, you have more barrier to entry, you have more room to work with, compared to if you keep going down the opposite direction to where you keep reducing the price, your perceived value when somebody comes across your brand goes down because they're comparing you to the next brand that offers the same product for a lower price point. When we look at brands like Louis Vuitton, Saint Laurent, these brands are charging $400, $500 price points for like a single wallet, right? So the thing is as well, we want to attract expensive customers because there's a certain echelon of customer base where money doesn't affect them. Recession, inflation, doesn't matter. Like they're still buying expensive stuff, right? So when we separate ourselves from the pack as a D2C brand by simply outpricing everybody else and throwing in a bundle offering where it's an irresistible offer, where if somebody were to buy 2 or 3 products and they get it at a specific price point compared to them just buying individual products, or you do like a offer stack of free products after a certain threshold of if they bought 2 products here and spent $80, they get 2 other hero verticals for free, and the perceived value goes up higher, right? That's the game. The game is in the offers and increasing your perceived value by raising your prices, by bundling up hero product verticals together and selling it to the market. That's how you efficiently scale. That's how you reach capital efficiency. That's how you get results in 2023 with rising inflation rates, possible recession, right? These are the variables you need to tap into. Really crafting that grand slam offer. On top of just offers, you have guarantees. You can offer free shipping, which I talked about earlier. You can do a 1-year warranty. And the thing is, when you offer warranty, you have to look at your metrics. But 9 times out of 10, people aren't going to do a refund. They're not going to want to do a refund. And the return on that is you get higher buying behavior because you build trust, you build security. And on top of that, you reduce the refund rate by simply offering that security to brand new prospects who've never heard about your brand. You get people in the ecosystem, they go into your community. Now they want to buy multiple other products because they know the quality is there and now they're not wasting their money. So there's a whole plethora of variables you can tweak with this kind of offer. And I covered a little bit about the offers and just playing on human psychology. People like stuff for free. People want to know that they're getting a bang for their buck and the quality doesn't diminish. So those are variable scenarios to take into account. I'm all for charging higher ticket prices and bundling hero products together and giving the perceived value up by doing that. And I think that's kind of the direction most D2C ecom brands have to go into if they want to be capital efficient. Because if you keep playing on price points, your CPA is going to, like, acquisition cost is going to continue to rise. It's going to be continuously more expensive to run on platforms like Facebook because there's so many other suppliers offering similar products. So the way you separate yourself from the competition is by charging higher ticket, looking at offering better guarantees, building that authority in the space with that perceived value, right? So these are the fundamentals that you want to tweak if you're trying to scale in 2023.